On this morning's Ag Issues program, a pleasure as always to bring back to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thank you.
All right, let's get to it. We got a lot to talk about specifically, though, with the Inflation Reduction Act that was recently signed by President Biden. And as you have stated here the last couple of times on this program, the issues that you have just for calling it that, as Democrats have put the program itself. But there are several things within this program, specifically tax-wise, that you could look at. And let's just go through some of the examples of specific things that they have in this program, because the devil's in the details, as they always say, and to say the least, a lot of devils in these details.
Well, they're sure I wrote I'd been working on for about 2.5 weeks. Once we saw the final version of the bill, it took, of course, I was on the road a lot in August, and so I could pick at it here and there, but it does take a lot of time to go through almost 800 pages of text and try to figure out what that means and what the implications of it are, and then try to write a cogent piece that will be helpful to people. And it ended up in about a 6,000-word blog article. I had thought that I should probably break this up and do it in chunks, but then I thought, no, I want to put it all in one spot. So that's what I did, and you're right. There's a bunch of stuff in here, and as I said in my piece, it's pretty hard to call this, at least to me, an Inflation Reduction Act. You can't have $750 billion of what I call fake money, have the Fed print money, and expect that inflation is going to be reduced. That's our core problem right now. We've had, starting in 2020, a quintupling of the money supply, and that gets us the classic Milton Friedman definition of inflation. We've got too much money chasing too few goods. That creates inflation. We're now in a recession. We've had 2 consecutive quarters of negative GDP. Greg, that could easily go to 6. We could have another year of negative GDP. The administration keeps pointing to unemployment being low, but if you dig into that, the labor participation rate is at historic lows that we haven't seen in 50 years. And so, your inflation rate your unemployment rate comes down, but it's because people are dropping out of the workforce. And if you take that to its logical conclusion, you could have a 0 unemployment rate if nobody's working. So that's a false, misleading statistic that's out there. The fundamentals in the economy are not good. And that has implications for agriculture. We still have supply chain issues, and we'll probably get into that a little bit later. And this bill does nothing to deal with the supply chain issues that we have in agriculture. So, there's a lot of detail in here. There's a lot of stuff, and I think there's a lot of concern for farming and ranching. While for our Kansas farmers, this year is going to be a pretty good year, a high-income year. As last year was. I don't think next year is going to be good. And our K-State data indicates that this year will be a good year financially, and that next year probably will not be as good. So, but we come back to this bill, lots of stuff in there.
Yeah, a couple of quick examples of that, the ability, or what they say reduces inflation, but you look at the numerous renewable energy related tax credits, you say that will not reduce inflation, but of the fact that you give an example of what happened in education several years ago.
Yeah, this is the thing. Basically, and you may have seen this with the so-called clean vehicle credits that's out there. They took the existing vehicle credits and ramped it up to $7,500 at the max, and then put in a used clean vehicle credit in a different part of the code, which is the lesser of $4,000 or 30% of the vehicle's cost. And as long as the vehicle selling price doesn't exceed $25,000. So you get it new and used. But I made the analogy here with respect to the vehicle tax credits is that not only will they not reduce inflation, they'll likely increase inflation. You've seen this all in news stories. Basically, the day after or the second day after the bill was signed into law, I saw first Ford and now GM announce that they're increasing the price of their electric vehicles by the cost of the credit. It's almost a dollar per dollar match. So in essence, the government is paying a buyer of an electric vehicle back their own money to buy an electric vehicle from a manufacturer that's raised the cost of the vehicle by the same amount. So the credit, it doesn't help the purchaser. It's a subsidy for the manufacturer. There's no real savings for the purchaser. And then in a twist of cruel irony, just last week, as I was coming back from speaking 2 days in Montana, I picked up a news story out of California where California is urging people, and I saw it again early this morning, don't plug in your electric vehicles because we've got grid problems in California. Well, this is shortly after California said, well, when we get to 2035, you're not going to be able to buy a gas-powered vehicle. Well, now you can't charge your electric vehicle. It's just the economic irony of this, of people not thinking things through, is just unbelievable to me.
All right, there are a lot more things here to discuss. And some of the tax provisions, some of the major tax provisions of the Act, you took a closer look at. Let's first start out with the 15% minimum tax on corporate book income rather than taxable income.
Yeah, this applies to C Corp that have annual adjusted financial statement income averaging over $1 billion in revenue over the prior 3 years. Now, that's not something that directly would involve or would hit a farming or ranching corporation. It might hit some food companies, the big food processors that are out there. But what this sets up is a minimum amount of tax that a corporation would pay. You're going to compute your tax in the normal way, and then you're going to do a recomputation based on this minimum tax by taking out and not factoring in deductions that you would otherwise take, and then you would pay the tax on the lower of those two. So it sets a floor, and that floor is going to be 15%. Now, the one provision in this that is somewhat related to this, and I'll come back to this provision in just a second, but also in this that's tied to this is that a company can't use, and this is any company, can't use NOLs that accrued before 2020. So for this purpose here, if you've had a net operating loss that accrued before 2020, now think of what happened in 2020. 2020 was when the virus hit, shutdowns occurred, and if you think back to 2019, the economy was humming along in 2019. It was at historic highs. Businesses were ramping up significantly through 18 and 19. We had the Tax Cuts and Jobs Act that started in 18 that was stimulating a lot of this. And there were a lot of these big corporations that had invested in equipment in 2018 and 2019 that actually were showing a tax loss. So it's an accounting loss. They're not really losing money, but they have a large NOL because of write-offs. They're making a lot of investment in equipment, in manufacturing facilities, and they're able to fast depreciate those. Whether that's bonus depreciation or 179 expense method depreciation. So they're showing a loss on the return. Well, the rule is that you can carry forward those net operating losses and use them in future years. Now here comes this bill that says, no, you can't carry forward, you can't use an NOL that accrued before 2020. So you had all this incentive in the tax, invest in your physical capital, your physical plant, so you can produce more products. The economy's moving along. You're hiring more people. Wages are going up. Now you come in and say, well, sorry, you can't use those losses now. That's going to be difficult. And in fact, the Joint Committee on Taxation has said that this provision is going to be particularly harmful to manufacturing firms. And the states that are going to get hit the hardest by this are Indiana, Kentucky, Michigan, North Carolina, and Wisconsin, where you've got a lot of this type of these companies that do manufacturing that have made these types of investments in capital. And what it does is it also claws back part of that $280 billion subsidy that was for the computer chip manufacturers, which was signed into law a couple of weeks before this bill was signed into law. So, yeah, that's going to be a tough one. The disallowance of NOLs is going to be difficult.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us, and we are breaking down some of the specific tax-related issues concerning the Inflation Reduction Act, and we're going to skip around a little bit because there's a lot to talk about, not a lot of time to discuss. But Roger, of course, there is in this Inflation Reduction Act, there is ag program spending that is taking place, and I know this is probably more of skimming through that, but we have talked about some, and you have talked about some as well. But what are some of the things that stick out concerning the ag program spending?
Well, usually this is done in a farm bill, so I wonder what the next farm bill is going to look like when all of this spending has already occurred for programs such as EQIP and CSP and the Ag Conservation Easement Program and drought relief in the Forest Service and payments to distressed borrowers and loan relief and the National Forest System. That's all in here. So I really wonder what the focus of the next farm bill is going to be when they've done this spending in here through fiscal year 2026 for these programs. And it's a lot of money. And the concern I have about that is, there's funding for ag programs, but that means there's also funding for the administrative agency to administer those programs. And I guess I'm a bit tainted in my view of these things. I was involved in a case against USDA NRCS where they basically, I would call it, harassed the rancher for 17 years, and I had to was part of the group that filed contempt actions back against the USDA secretary multiple times to get them to follow the court's order in that case. So I always, carrots come with sticks, and I know that. So, yeah, there's funding. But when you get into these programs, that does allow the government to dictate more control over your operation, and you got to follow certain rules that come along with that funding. So people can take a look at the article and then get the details on the amount of funding. It's just that the additional concerns, at least I have, maybe some don't have the same level of concerns, but I sure do when any type of administrative agency gets involved in your business.
Also, you look at the increased Obamacare taxpayer subsidies, and I think back to when President Obama said that the ACA would save the average family a certain amount annually in health care costs, but I think it's safe to say many of us have not seen that.
Yeah, what have you done with your $30 that you've saved now, Greg? He said it was going to be $2,500 savings every year. That started in 2010. So we're 12 years into that. That's about $30,000. And I like to mention that at seminars. What have you done with your $30,000? What have your clients done? And everybody kind of snickers and laughs at that. But more people will be. There's increased subsidization of the healthcare exchanges. And if you're over 400% of the poverty line, you can still now qualify for the premium tax credit if the medium cost silver plan would be more than 8.5% of what your household income is. And there's a lower applicable percentage of household income for all income levels. So they've increased the subsidies. And the other thing I would point out kind of related to this is Medicare. What we're going to see is, and this is going to be scary, and I think rural hospitals get hit the hardest by this, an unfunded mandate is coming. The government's about ready to pull back on providing or covering the cost of COVID-related drugs and treatment, and that's coming. Because the administration announced in mid-August their intent to stop paying for COVID vaccines and treatments. Well, those have been provided at no charge to patients, but the providers have been compensated with taxpayer dollars. Your rural hospitals are going to be in this, and they're not going to get compensated for this. So I think this additional cost is going to be borne by taxpayers. I think it's probably reasonable to anticipate that rural hospitals are going to be disaffected the most. So here we have another unfunded mandate coming from Washington, D.C. We just better be prepared for it.
Two gigantic ones, and I know you definitely talked about these two. Well, one at least concerns the IRS, Internal Revenue Service, getting approximately $80 billion with a B in IRS funding over the next 10 years. For the main purpose is to hire 87,000 agents.
Yeah, a lot of the media stories that have been out there in the national media on this, yeah, that sounds like a lot. IRS is facing the retirement of over 50,000 agents in the next few years, so a lot of this is designed to replace those. So it's not like we're going to double the size of the IRS in terms of their audit force that's out there. There's a lot that have retired. There's a lot that will retire. So this will replace them and get them above replacement level, and it's over 10 years. Now, the problem with that $80 billion is that only $4 billion is targeted to go to taxpayer services. And that's really, in my view and many practitioners' views, that's where the money needs to be. Get somebody that can answer the phones and get you to somebody that can answer your questions in the IRS. That has been a tremendous problem. Get somebody that can get forms updated. The service aspect of IRS is woefully lacking, and that receives the least funding of all of this. And then the real problem I have that I think is really concerning and should be, we all remember how President Obama weaponized the IRS, the whole Lois Lerner scandal and all of that. The person that's now been put in charge of administering this $80 billion was Lois Lerner's right-hand person. It's another lady, Nicole Flax, and she's one of several senior IRS officials during that scandal in the Obama years that had their emails that conveniently really worry about that. She is highly partisan. We're going to have to keep an eye on that. But the audit rate for IRS has been very, very low. Probably over the next 10 years, it will go up. That will not just simply be focused on higher income people because it's easy pickings, it's low hanging fruit. If you go after the kind of the middle area, the people that aren't represented by tax counsel, you can pick up a lot of money that way. So that's a concern that I have as to what they're going to do, and the fact that they're not really prioritizing funding for taxpayer services in IRS, and that's really where a lot of this money should be.
And I just want to tell people we're going to go long here. We got a couple more things we want to look at, let alone the part of this being the student loan forgiveness, which we could probably do literally a whole program about.
Yeah, we certainly could, Greg. This is one thing that's disturbing to a lot of people just because of the unfairness of it. If you got a student loan, you worked hard, you went to school during the day, worked at night to get that loan paid off, or even didn't take out a loan. You waited to go to school until you had the money to do that. You sacrificed other things, and now you see other people that are getting their loans paid off by you because the cost is being shifted to you as a taxpayer. Yeah, that's tough. Now, the question is, from a legal standpoint, is it constitutional? I think the answer to that is clearly no, but will it be challenged? Now, what the administration is doing is they're basing their justification for it on the HEROES Act, which was a post-9/11 law, the Higher Education Relief Opportunities for Students Act of 2003. They're relying on that to justify the action. And then that act did give the Education Secretary the authority to waive rules related to student financial aid programs in times of war or national emergency. Now, the question I would raise on that is, COVID of August 2022, the same thing as COVID in August of 2020? And clearly the answer is no, it's not. And the they're trying to argue, well, we're still in a national emergency. Well, maybe there's a designation that's out there, but it's certainly not anything like it was 2 years ago. And the administration's lawyers in their memo didn't explain how forgiveness complies with the requirement of the HEROES Act, that the forgiveness is necessary to protect borrowers that have the ability to repay their loans. It's woefully inadequate on that. And then they're going to have to deal now with a U.S. Supreme Court opinion. I think you and I have talked about this shortly after the opinion came out. It's the West Virginia against EPA case on the major questions doctrine. And when you have this type of spending done by the executive that is very substantial from an economic standpoint, this is supposed to originate in the Congress and specifically in the U.S. House when there's spending that's involved. And the Supreme Court in the West Virginia opinion brought up the major questions doctrine. And that case was viewed as a big win for agriculture because they said the EPA, you don't have the authority to change the way energy is produced in this country by administrative announcement, by fiat. That has to come through the Congress. And now the administration has to deal with that view of the U.S. Supreme Court. And I don't think the court, as currently constituted, is going to agree that this is constitutional. Now, to get there, somebody has to have standing. And the question is, who's been disaffected that could sue? Well, any type of lender that's directly or indirectly involved and is not being able to collect interest or get that loan repaid to the extent it's been forgiven is obviously affected. So is the U.S. House. And if you remember, the U.S. House of Representatives brought lawsuits under Obamacare. They challenged that. Now, currently constituted, the House is not going to sue. That would require a change this fall and then the seating of the new House in January. And so that's down the road a bit until the House would sue. So somebody with standing such as a bank, a lender that's involved, or even somebody that is at income level of $125,001, just right over the threshold, who doesn't get their loan forgiven, but lives, let's say, in New York City or some high-cost area, severely disaffected by this, I think that person would have standing. So somebody in a very high-cost area that's just over the threshold probably has standing also. And so somebody like that could sue Junction, get it stopped until a court could hear the whole thing on the merits. Maybe by that time the House would be reconstituted, and then the House is really the proper body to challenge this, and then they could challenge it. So it remains to be seen. But all of this stuff is going on in the economy at a time when it's pretty rough. And I've included about a 90-minute session in many of my one-day and two-day seminars talking about ag economic issues as to where we're headed and what do practitioners need to do for their clients to prepare them for now, from a tax standpoint, as we go into the next year. And I'll tell you, Greg, I just came back from Montana, and it's a different scene in the West. I've had Colorado, I've had Washington, I've had Montana as three states where I've spoken at quite a bit in August. And the drought is taking its toll on ranchers out west. It's not the same economic situation out there as it is for us with respect to Midwest grain farmers, for example, and even out in western Kansas where the drought has reached. It's going to be tough for some, even though statewide we're going to be pretty good. So it's different. Agriculture is different depending upon where you're at in the country. And so these issues are important. What the Congress is doing, not what we need to be doing is cutting spending and trying to facilitate, make it easier for companies to hire people and generate income. The Fed is going to increase interest rates. So we got to be prepared for that too. We really, frankly, those interest rates should be a lot higher now to get this inflation problem dealt with, like it was dealt with 40 years ago in the Reagan administration. There was a lot of economic pain, but inflation was wrung out of the economy. But we can expect probably by the end of the year another 1 to 2 percentage point increase in the interest rate, and that has implications for agriculture, has implications for land prices, as well as anybody that wants to borrow money.
All right, Roger, unfortunately we were way out of time, but if people want more information or like to read your blog article that you and I have been discussed, what's the best way they can do that?
They can go to my website, which is washburn.edu/WALTR, and then down the left side they'll see the link to the Law Professors Blog Network, and you can find the Ag Law and Taxation blog there.
All right. Roger, as always, much appreciated, and I'm sure we'll have more further discussions on this on later dates, but as always, appreciate it.
Thank you.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the Ag Issues program here on 580 WIBW.